On March 27, 2002, during a routine first-quarter earnings call, Adelphia Communications disclosed a number it had never carried on its balance sheet. The figure, $2.3 billion in co-borrowing liabilities. The disclosure ran one sentence in the supplemental materials. Within minutes, analysts on the line asked the same question in different phrasings. Was Adelphia liable for this debt? If so, why had it not appeared in the company's reported obligations? The answers were not clean. This episode answers one structural question. How could a publicly traded cable operator be jointly and severally liable for billions of dollars in bank debt while reporting a balance sheet that disclosed none of it? The instrument at the center of Adelphia is the co-borrowing agreement. In isolation, the mechanism is mundane. It was common in the cable industry. To understand the fraud, you first have to understand the legitimate structure it inverted. Cable systems are capital intensive. Building and upgrading physical plant, the coaxial and fiber that runs to homes, requires sustained borrowing. In the 1990s, cable operators commonly financed this through syndicated credit facilities, large revolving loans extended by groups of banks. To reduce their lending risk and to lend at scale, banks frequently structured these as co-borrowing facilities. Under a co-borrowing agreement, multiple related entities sign onto a single credit facility and become jointly and severally liable for the entire balance. Joint and several liability means each borrower is independently responsible for the full amount, not its proportional share. One entity draws and cannot repay. The lenders can pursue any of the co-borrowers for the entire outstanding balance. For the banks, this is attractive. It broadens the pool of assets and cash flows standing behind the loan. For the borrowers, it lowers the cost of capital, because the lenders price in the combined creditworthiness of all the co-borrowers rather than each one in isolation. Here is the legitimate accounting treatment. When a public company is a co-borrower on a facility, it is liable for the full amount. Joint and several liability is not a contingent obligation that can be footnoted and set aside. It is a direct liability. Under generally accepted accounting principles, if a public company can be compelled to repay the entire balance, that balance must be reflected on its balance sheet or, at minimum, disclosed in a manner that makes the company's exposure clear to investors. The full amount of the joint liability is the company's obligation. It does not matter who drew the funds or who is expected to repay them. This is the baseline. A co-borrowing facility creates real, direct, disclosable liability for every entity that signs it. The structure assumes the co-borrowers are related operating entities whose combined cash flows back the loan, and that the public reporting entity discloses its full exposure. Now consider what Adelphia was. Adelphia Communications Corporation was a publicly traded cable operator, one of the largest in the United States by subscribers. The Rigas family founded and built it. The record establishes that the family retained both operating control and a controlling voting interest through a dual-class share structure in which the family's shares carried disproportionate voting power relative to the publicly held shares. This is the first structural element. A family controlled the public company. The same family also owned, separately and privately, a set of entities outside it. These private entities were cable systems and partnerships owned by the Rigas family directly. They were not subsidiaries of Adelphia Communications. They were not consolidated into Adelphia's financial statements. They were a parallel set of holdings, controlled by the same people, sharing management, sharing infrastructure, but legally distinct from the public reporting entity. The SEC enforcement record refers to these collectively as the Rigas family entities, or the managed entities. The co-borrowing facilities tied these two worlds together. According to the SEC's complaint, Adelphia subsidiaries and Rigas family entities entered into joint credit agreements as co-borrowers. The public company's operating subsidiaries and the private family-owned entities signed the same syndicated loans. Under those agreements, every co-borrower was jointly and severally liable for the entire balance drawn under the facility. This is the pivot point. When a public company and a private entity controlled by the same insiders are co-borrowers on the same facility, the public company is liable for amounts borrowed by the private entity. The private entity draws $1 billion and cannot repay. The lenders can demand that full $1 billion from the public company. The public company's shareholders bear that risk. So the accounting question is unavoidable. How much of the co-borrowing balance must appear on the public company's books? The honest answer: the full amount of the facilities on which Adelphia entities were co-borrowers. Joint and several liability is full liability. What the record establishes. Adelphia did instead was selective. The company recorded on its own balance sheet only the portion of the co-borrowing debt that corresponded to amounts it claimed to have drawn for its own use. The remainder, the amounts drawn by or attributed to the Rigas family entities, was moved off Adelphia's balance sheet and onto the books of the private entities. Adelphia remained legally liable for all of it. That moved portion is the phantom spread. Adelphia carried the legal liability without carrying the reported debt. The $2.3 billion disclosed on March 27, 2002 was, in substantial part, co-borrowing debt for which Adelphia was contractually liable, but which it had been reporting as the obligation of the family's private entities. Structurally, Adelphia had spread a single joint liability across two sets of books and disclosed only one side. To understand how this was sustained, walk through the architecture. The record establishes that this was not a single transaction. It was a system operated over years with several interlocking components. Step 1. The dual-class control structure. The Rigas family controlled Adelphia Communications through supervoting stock. The same family owned the Rigas family entities outright. Because the same people sat on both sides, the co-borrowing agreements between Adelphia subsidiaries and the family entities were not arm's-length negotiations between independent parties. They were transactions among entities under common control. This common control made the rest of the architecture possible. The people deciding how to allocate the co-borrowing debt between the public company and the private entities were the same people on both sides of the allocation. Step 2. The co-borrowing facilities themselves. According to the SEC, 3 principal co-borrowing facilities were established under which Adelphia subsidiaries and Rigas family entities were jointly and severally liable. The aggregate amounts available ran into the billions. The banks extended credit to the combined group. Funds drawn under the facilities could flow to Adelphia subsidiaries or to the family entities. The lenders looked to the combined borrower group for repayment. From the lender's perspective, this was a single integrated credit. Step 3. The allocation. This is where the off-balance sheet treatment was manufactured. The total drawn under the co-borrowing facilities was divided. A portion was recorded as debt of Adelphia. The remaining portion was recorded as debt of the Rigas family entities. Because Adelphia did not consolidate the family entities, the portion allocated to them did not appear in Adelphia's consolidated financial statements. The SEC's complaint establishes that the amount excluded from Adelphia's reported liabilities through this mechanism reached approximately $2.3 billion. Adelphia was liable for that full amount under joint and several liability. It reported none of it. Step 4. The reclassification entries. The record describes how Adelphia recharacterized co-borrowing debt to shift it off its books. The mechanism involved netting the co-borrowing liabilities against amounts purportedly owed to Adelphia, or attributing the borrowings to the family entities through intercompany entries. The effect was to present Adelphia's leverage as substantially lower than its actual legal exposure. According to the SEC, this allowed Adelphia to report compliance with debt covenants and to present a balance sheet that understated its obligations. Step 5 turned an accounting distortion into a wealth transfer. The cash use. The SEC alleged, and the record establishes, that funds drawn under the co-borrowing facilities for which Adelphia was liable were used for the benefit of the Rigas family. The proceeds financed purchases of Adelphia securities by the family, the construction of a golf course on family land, the acquisition of timber rights, apartments in Manhattan, and other expenditures. The family drew on credit backed by the public company's liability and directed the proceeds to private purposes. Meanwhile, the corresponding debt was booked to the private entities, not to the public company that stood behind it. Consider the structure as a closed loop. The public company's creditworthiness and assets backed the co-borrowing facilities. The family drew on those facilities. The debt was recorded on the family entity's books, not Adelphia's. The proceeds funded family purchases, including purchases of Adelphia stock that maintained the family's controlling position. And Adelphia's reported balance sheet showed a leverage profile that did not reflect the $2.3 billion of liability it actually carried. The SEC documented a second layer, the cash management system. Adelphia operated a centralized cash management system that pooled funds across both the public subsidiaries and the private family entities. According to the SEC, this commingling made it difficult to trace which entity's cash was funding which obligation. The same system that delivered operational efficiency also obscured the flow of funds between the public company and the family's private holdings. When the SEC later traced the transactions, it found the boundary between Adelphia and the Rigas family entities had been, in practical terms, porous. A third element rounds out the architecture: the reporting of operational metrics. The SEC's complaint addresses not only the debt, but the inflation of Adelphia's reported financial and operating results. The record describes the use of fabricated transactions and improper accounting to meet analyst expectations for subscriber numbers and cash flow. The co-borrowing scheme reduced reported leverage. The operational misstatements supported the equity valuation. Together, they presented an Adelphia that was healthier and less indebted than the entity that actually existed. Hold those components together: the dual-class control, the co-borrowing facilities, the selective allocation, the reclassification entries, the use of proceeds for family benefit, the commingled cash management, the operational inflation. That is the org chart. Two sets of books under common control, joined by joint and several liability, with the liability disclosed on only one set and the proceeds flowing to the other. Now, The question this channel always asks. The structure was large. The co-borrowing agreements were signed documents held by major banks. The liability was legally unambiguous. Why was it not detected for years? The first answer concerns the nature of the disclosure failure. Co-borrowing debt is disclosed when it is disclosed properly in the notes to the financial statements and in the discussion of liquidity and capital resources. The SEC's findings establish that Adelphia's disclosures regarding the co-borrowing facilities were inadequate and, in material respects, misleading. The footnotes did not make plain that Adelphia was jointly and severally liable for billions of dollars recorded on the books of the family entities. For an analyst or auditor to detect the exposure, they would have had to read the co-borrowing agreements themselves, understand that joint and several liability is full liability, and then compare that legal exposure to what Adelphia actually reported. The disclosures as written did not invite that comparison. The second answer concerns the role of the auditor. Adelphia's financial statements were audited. An audit of a co-borrowing structure should examine the credit agreements, confirm balances with the lending banks, and assess whether the full joint and several liability is appropriately reflected or disclosed. The structural difficulty is that the co-borrowing facilities were genuine. The agreements existed. The bank balances could be confirmed. The question was not whether the debt existed, but how it was allocated between the public company and the private entities. And that allocation was an internal characterization controlled by the same management on both sides. An auditor confirming the existence of the facilities and the gross balances would find them. Whether the auditor challenged the allocation and whether management's representations about the entity's separate obligations were tested against the legal reality of joint and several liability is the point at which verification would have had to occur. The third answer concerns the related party problem. The transactions between Adelphia and the Rigas family entities were related party transactions. Related party transactions are required to be disclosed precisely because the absence of arm's-length bargaining creates the risk that terms will not reflect economic reality. Adelphia did disclose related party relationships in general terms, but disclosure of the existence of related parties is not disclosure of the magnitude of liability flowing across the related party boundary. The structure exploited the gap between acknowledging that related parties existed and quantifying what the public company's shareholders were exposed to as a result. The fourth answer concerns the gatekeepers who price the debt, the banks and the rating agencies. The lending banks understood the co-borrowing structure perfectly well. From their perspective, joint and several liability was the entire point. They had structured the facilities to capture the combined credit of all the co-borrowers. The banks were not deceived about Adelphia's liability. They were relying on it. The parties most knowledgeable about the true extent of Adelphia's obligation were the lenders. And the lenders had no incentive to draw public attention to a liability that benefited them. The information asymmetry ran against the public shareholders and in favour of the most sophisticated participants. The fifth answer concerns covenant compliance. The co-borrowing facilities, like most credit agreements, contained financial covenants, leverage ratios, coverage ratios, limits on additional debt. The reclassification of co-borrowing debt off Adelphia's balance sheet allowed Adelphia to report compliance with covenants it might otherwise have breached. Covenant compliance is itself a signal that other parties rely on. An entity reporting compliance is presumed to have the leverage profile it reports. The off-balance sheet treatment did not merely understate debt to equity investors. It preserved the appearance of covenant compliance that creditors and analysts read as a sign of financial health. For detection to have occurred earlier, several things would have had to be true. An auditor or analyst would have had to obtain the co-borrowing agreements, identify the joint and several liability provisions, recognize that the full facility balance was Adelphia's legal exposure regardless of internal allocation, and then trace where the off-balance sheet portion had been recorded. They would have had to treat the allocation between public and private entities as a related party transaction requiring scrutiny rather than a settled fact. And they would have had to do this against management representations from a family that controlled both the public company and the private entities, and against disclosures drafted to obscure rather than illuminate the exposure. The verification chain depended at every link on someone challenging an internal characterization controlled by the parties who benefited from it. The unraveling began, as the cold open established, with a single disclosure on March 27, 2002. The trigger was specific. On that first quarter earnings call, Adelphia disclosed the existence of the co-borrowing liabilities. The record reflects that this disclosure emerged in the context of a footnote and follow-on questioning. Analysts pressed on whether Adelphia was responsible for the co-borrowing debt. The answers did not resolve the question. The market's reaction was immediate because the disclosure changed the fundamental arithmetic of the company. An entity that had appeared to carry a certain level of debt was now understood to be liable for billions more. Once the question was in the open, it could not be contained. The underlying fact was binary. Either Adelphia was jointly and severally liable for the co-borrowing facilities, or it was not. The credit agreements answered that question. It was. As analysts and then regulators examined the structure, the off-balance sheet treatment collapsed under the weight of the legal liability it had concealed. The sequence accelerated. In the weeks that followed, Adelphia delayed its annual report, unable to finalize financial statements that now had to reflect the previously unreported liabilities. The delay in filing the Form 10-K was itself a signal to the market that the accounting could not be readily reconciled. The auditor relationship came under strain. The board formed a special committee. Members of the Rigas family resigned from their executive and board positions. The SEC opened an investigation. In June 2002, Adelphia Communications Corporation filed for bankruptcy protection under Chapter 11. The off-balance sheet structure that had presented a manageable leverage profile gave way to a reorganization in which the true scale of the company's obligations had to be confronted. Bankruptcy made the full extent of the co-borrowing liabilities a matter of legal record. In bankruptcy, every creditor's claim must be accounted for, and the co-borrowing lenders held claims grounded in the joint and several liability the company had not reported. The enforcement action followed. The SEC filed suit, and its complaint laid out the structure in detail. The co-borrowing facilities, the fraudulent exclusion of approximately $2.3 billion in liabilities from Adelphia's reported financials, the misuse of facility proceeds for the benefit of the Rigas family, and the inflation of operating results. The SEC's complaint alleged that the defendants had engaged in one of the most extensive financial frauds ever to take place at a public company. The Department of Justice brought criminal charges. The criminal trial established findings of fact through a jury verdict. The record shows that John Rigas, the founder, and his son Timothy Rigas were convicted on charges including securities fraud and bank fraud arising from the scheme. The convictions established, as a matter of judicial record, that the co-borrowing structure and the associated misrepresentations constituted fraud. A second son, Michael Rigas, was acquitted on certain counts, with the jury unable to reach a verdict on others. He later resolved his matter through a separate disposition. This episode does not characterize the conduct of any individual beyond what the courts and enforcement actions established. State the mechanism of collapse precisely. The fraud depended on the public market accepting a reported balance sheet that did not reflect Adelphia's full legal liability. The instant the co-borrowing liability was disclosed, the reported balance sheet lost its authority. Investors and creditors recalculated the company's leverage using the true figure. At the true figure, the company's equity value and its capacity to service debt looked entirely different. There was no gradual erosion. The disclosure of a single number reset the valuation, and the reset was severe enough that the company could not maintain its financing or its listing. Adelphia was delisted from the Nasdaq within weeks of the disclosure. The structure that had taken years to build was undone by one sentence, because the sentence stated a fact that contradicted everything the financial statements had implied. The bankruptcy proceedings and subsequent litigation also addressed the role of the lending banks. The co-borrowing lenders had structured and funded the facilities. Litigation arising from the bankruptcy examined the bank's knowledge of and participation in the structure. Settlements resolved claims relating to the bank's roles. The record of those settlements reflects the structural reality already noted. The lenders understood the joint and several liability, because they had designed the facilities to capture it. What does Adelphia establish about the mechanism? First, it establishes that joint and several liability cannot be allocated away through internal characterization. The legal exposure under a co-borrowing facility is the full balance for every co-borrower, regardless of who drew the funds or whose books the debt is recorded on. The fraud did not invent a new instrument. It misrepresented the consequences of a standard one. The location of a liability on a set of books is an accounting choice. The liability itself is a legal fact. The two can diverge until an event forces them to reconcile. Bankruptcy is such an event. So is disclosure. Second, it establishes the danger of common control across a public-private boundary. The entire architecture depended on the same people controlling both Adelphia and the Rigas family entities. Common control removed the arm's-length friction that would otherwise have constrained how liabilities and proceeds were allocated between the two sets of books. Every transaction across that boundary was a related party transaction. The protection investors are supposed to derive from related party disclosure failed, because disclosure of relationships is not disclosure of exposure. Third, the case produced concrete regulatory consequences. Adelphia was one of the corporate failures that shaped the legislative response of the early 2000s. The Sarbanes-Oxley Act, enacted in 2002, imposed requirements directly relevant to the failures Adelphia exhibited. Executive certification of financial statements, strengthened auditor independence, and enhanced internal control requirements over financial reporting. The off-balance sheet treatment of liabilities and the use of related entities to hold obligations away from public view became a focus of subsequent disclosure reform. The requirement that public companies disclose off-balance sheet arrangements in their management discussion and analysis was tightened in the period that followed. The finding is structural and narrow. A co-borrowing facility creates full liability for every co-borrower. When the co-borrowers include a public company and private entities under common control, the allocation of that liability between them is meaningless as a matter of law. However, it is recorded as a matter of accounting. Adelphia recorded the allocation that flattered its balance sheet. It disclosed the relationship but not the exposure. The phantom spread held for as long as no one forced the legal liability and the reported liability to meet. On March 27, 2002, in a single sentence, they met. The record closes there.